We are right at noon. I know we have a lot to cover, so should we dive in?
Yeah, let's dive in. We had record-breaking numbers today,
Excellent.
which seems like a trend. Let's keep that up. All right, so hello everyone, and welcome back. I'm Austin Hageman, an advisor here at the firm, holding the CFA, CFP, and AWMA designations. I'm joined by my colleague Adam Armstrong, who also serves as an advisor and holds the CFP designation. Today, we'll walk through highlights from our quarterly market update deck, focusing on key charts and data points that inform our investment committee decisions. As always, feel free to submit any questions through the Q&A box on your screen. We'll do our best to answer them during the session, and if we don't get to yours, we'll be sure to follow up afterwards, either directly or indirectly. Since we have non-client viewers who may not be familiar with us, here's a quick 30-second overview on the firm. We are an independent registered investment advisor serving high net worth and ultra high net worth individuals and institutions. As a true fiduciary, we provide advice, not products. We aren't paid commissions and we don't receive kickbacks or incentives to promote specific investments. Our compensation comes directly from our clients, and that is specifically for the advice that we give and the investment management that we deliver. Our investment teams offer institutional level access to a broad, transparent, and objective investment universe, along with connections to multiple private banks, helping to ensure our clients benefit from true open architecture solutions. All right, Adam, we have a lot of slides to cover, so I shortened that a bit more than usual. You ready to jump on in?
Yeah, let's jump right in. It's been a heck of a quarter. I know there was, we were liberated from a bit more of our unrealized gains
Yes.
since the end of the quarter, but we're gonna dive a little bit into market performance, um, lay the land for tariffs, talk a little bit about our outlook for the future and whether, we should be worried, putting more money to work, et cetera. Um, so on the slide here, first, we're going to talk about the first quarter returns. This is through March 31st. Like I said, after April 2nd, the market did sell off more. So we'll touch on that a bit, where we are today versus where this snapshot was taken at the end of the quarter. But on the left side, we'll start with the sectors of the economy, right? So the S&P 500 is broken down into 11 sectors: energy, healthcare, utilities, all the way down. We have it ordered here in terms of which sectors did the best at the top and which were lagging sectors down towards the bottom there. The market as a whole was down about 4.6%, which we can see at the very bottom. That's the S&P 500. And what jumps out at me here is a couple things. There were only two sectors out of the 11 that were worse off than the overall index. Now, there's a couple reasons for that. Consumer discretionary was actually the worst, in large part due to Tesla, which had a very big run up after the election, just given Elon Musk's proximity to the White House and some optimism there. I don't think it had anything to do with Tesla, the company itself, just Elon being close to the White House and President Trump. It actually underperformed technology, which was a bit surprising. But you can see here everything else, the other nine out of the 11 sectors in the economy were either very slightly negative or positive on the quarter, right? So I think it's important to note we did end the quarter, I believe, technically in a correction, which is down more than 10% from recent highs. But the market as a whole was only down 4.6% on the year, right? We started the year off pretty well and then corrected from there. So this jumps out as being significant. It stresses the importance of staying diversified across your portfolio. Also, some of the things that have worked well over the prior 2 years, reverse trend in the first quarter. Whether that's signs of changing times ahead, or whether this is a one-time sort of reset and rebalance, to be determined, right? I know a question came in prior to the webinar even. We had talked about the markets generally being overvalued. So was this just an excuse to let off steam, or is there real concern underlying fundamentals from some of these tariffs and a slowdown in growth, et cetera? A lot of that is to be determined.
Right. And to that point, just to echo that, we could really point back to what we did talk about on that last quarterly market update, where looking at valuations, we were saying that the top 10 names, there was a higher chance of heightened volatility out of those names. And it's those names that have really let us down, right? Those are the technology names, that's Tesla, et cetera. So, we're not always right away. We're not always right. But this happened to play out pretty well from quarter to quarter. And it just really reemphasizes the fact that paying attention to risk, paying attention to having a broad opportunity set can pay off in the long run from a volatility management perspective and over, very long periods of time, managing that return profile.
I'll note too that even including April, which saw more volatility, the trends that we're seeing with the sectors of only two sectors being worse than the overall index is still consistent. Okay, so everything's probably shifted a little bit more negative after today. I know the market's up on some positive news with tariffs, but taking a look at the end of last week, all of these trends are still consistent, which is encouraging. Um, and reinforces what we talked about in the wintertime. On the right side of your screen, shifting gears a bit, we looked at different things like regionally, where is performance coming from a market cap perspective and size, where are things coming from, and from a style, growth versus value perspective, where do we stand after the end of the quarter? Uh, Probably the biggest thing that jumps out to me is just the divergence of foreign stocks versus US stocks. Um, so looking at the total US equity market versus just the S&P 500, which is large companies, you can see US stocks were down almost 5%, whereas foreign stocks were up almost 6%. That's a huge divergence. Again, is this just a relative valuation question, a reversion to the mean of what we had seen the prior couple of years working really well, US large cap companies versus foreign counterparts? Maybe is this a question of expectations versus reality, right? The expectations for Europe and a lot of foreign nations were so rock bottom low. Valuations were historically attractive relative to US companies. Um, since the tariff argument has come into the picture, we've seen foreign governments install more fiscal policy, which is positive for growth in the long term. So could this be a little bit of just reversion to the mean? Sure, but there might be some truth to this trend continuing on if there's less reliance on U.S. funding for certain things, right? Germany was the big one in the news, putting billions and billions of dollars into their own, building up their own defense, right? So less reliance on the U.S. there, given the tariff spats that are going on. From a
Right.
size perspective, we talked about, we looked at if you take all the 500 companies in the S&P and weighted them equally, right? Versus have the bigger companies having more of an impact, you can see that clearly the big companies are doing worse than the medium and smaller companies out of the biggest 500 companies there. So a lot of the times we referred to the Mag 7, the Magnificent Seven companies, right? Or we talked about the top 10 concentration in the index. You can really see here that a lot of more steam relatively was let out of those overvalued, highly concentrated, bigger cap companies relative to their smaller counterparts. And then finally, a lot of those big companies tended to be growth companies, tech companies. So growth has really taken a hit here relative to the value companies within the S&P 500 again. So I think this all just stresses, hey, we don't want to assume that moving forward, this divergence will continue. It might not, right? We have to see what happens here. But it is worth noting and remembering to always stay diversified within your investments. Have a plan, have a strategy, and be thoughtful about it. Take gains from winners when they do well, put more money into losers if you still believe in them.
Right. Right. I mean, I think we should take a moment for the underdog here, international stepping up big, right? This 10% spread between international and US performance this year. If if international keeps up this performance, I'm not saying it's going to, but if you extrapolate the returns over the first 3 months over the next 12 months, that's over a 20% return, which would be something for international. And who would have thought that electing Trump president would be the catalyst? We've been, as advisors, as investment analysts, research teams, all of them, we've all been saying, valuations look more attractive overseas. Valuations look more attractive year after year after year. The swing, it will eventually happen. Typically there's drawn out periods where one outperforms the other, but it does revert. And we're not saying that now is going to be the time that this is going to be the big switch, but just to point that out, one of the reasons to hold asset classes from different countries, right, and all different levels of sub asset classes and things like that, is for diversification for periods like now where it can help in terms of overall risk management.
The market's often been referred to as the great humiliator. It does what you least expect. So, of course, we elect someone who has an America first agenda and foreign equities outperform, right?
Right.
Everyone expected
Right. So,
that.
speaking of catalysts, tariffs, right? Tariffs can be blamed for a good portion of what we're seeing on our screen. So let's dig in a little bit to the tariff conversation.
Yeah. So, Austin, why don't you walk us through what we're looking at here in this slide? For everyone listening, we're going to set the stage of, where were we with regards to our tariff rates on various goods versus various countries, et cetera. And then we're going to try and talk about some of the goals that the administration is looking to achieve and why there could be complications in some of those goals that they're trying to get done.
Sure. So the data on our screen right now is as of the end of 2023, and we're looking at the average tariff rates of the US and its top 10 trading partners. So as you could see on the screen, US clearly had the lowest tariffs out of all of our top 10 trading partners. It appears from what we've heard from the administration that Trump looked at this, and one of the things he said was, wow, we're not using tariffs well enough. We could be getting ripped off in this area. I look at this and I say, you know what? More established countries tend to have lower tariffs. That is evident from the screen when you look at which countries are more established and where their tariff rates are. It also makes sense, in that for less established countries, tariffs come in terms of protecting their young industries, right? Their industries aren't as established, so they need to add a little bit of protection there. And then also for less established countries, it's harder to collect income taxes to generate revenue, right? Either there's corruption, or they don't have the right infrastructure, or the country is just too poor to begin with, where they can't generate that revenue from income taxes, that government revenue from income taxes. So tariffs is really what they need to lean on, and that's what you see. I mean, there are a few other reasons, but I look at this and say, yeah, this probably makes sense given how established we are. Now we know that since this point, since the end of 2023, the average U.S. tariff has jumped to 20%, above 20%, and has floated around. We'll see, if any news comes out about China in the near future to bring that back down. But it has jumped significantly to, be theoretically the highest on this page right now.
A lot of what we export as a country, right, is not a tangible good, right? We are not a manufacturing based economy anymore. And whether it's knowledge or security or our debt, right? Because the US currency is the global reserve currency for the world at the moment, right? That doesn't really show up here. So I think to your point, as countries, as a country's economy evolves and grows and matures, we export different types of goods and don't need to tax. We don't need to have the tariff revenue coming in from these sources. We have other methods of collecting revenue. So the next slide here, we're going to look at just again laying the groundwork for where we are today. Our top 10 trading partners over here on the left, you can see that Mexico, China, and Canada do account for 42% of total imports. This was in 2024. Germany there, Japan, Vietnam, and some of the other countries make up the rest. And then we also highlighted the top five goods that we import as an economy, and the makeup of those top trading partners. So many of the machinery products, electronics, automotive products are made or come from some of these top trading partners here. Pharmaceutical goods is not very plentiful from those top three trading partners, Mexico, China, and Canada. But things like electronics or autos are, right? So that's probably why you hear more about those goods relative to some of these others, because our top trading partners make up of the lion's share of some of these top goods that we do import.
So let's jump into the goals of why the tariffs were put into place and some of the complications.
Right. So now that we know the lay of the land, what's the point of putting tariffs or increasing tariffs as a country, right? We scoured the interwebs for what Trump is saying and what the administration is looking to accomplish. So we boiled this down into four main goals and then wanted to highlight some of the complications with each one of those, or side effects, unintended consequences, if you will. The first one is just, make trade more fair and boost our own domestic manufacturing. This seems pretty reasonable to me. Would you agree?
Yeah. Yeah. Well, everyone loves fair trade, right?
Yeah, and having less reliance on foreign nations, foreign governments, where there's more corruption potentially, higher taxes, whatever it might be, that seems reasonable. The problem here is that this could significantly increase costs, right? If we onshore more manufacturing to our states. We have a higher quality of living. People expect to be paid more, and it's going to have to flow through to the consumer at some point, right? There was a study done. If you look at the iPhone, for example, it's made over in Asia. It costs what for the lowest model? Let's say $1,000. I think they estimated that the lowest models would cost somewhere around 3,000, upwards of $3,500 for an iPhone, right? That's almost triple the cost plus. Um, for something that's so integral to our lives today. So that's just an example of one good that if we onshored that manufacturing, it would cost more, right? There's no way Apple would still sell it for $1,000 a phone and take a loss on every unit that they sell here, right? So there's a reason why things are manufactured abroad. It's not good for the manufacturing industry here in the United States, but that is a conscious choice we've made really since World War II, when we've promoted globalization, things like free trade, right? It benefits us here in the United States with deflationary pressures to have things made for cheaper elsewhere. So it's a reasonable goal, but the outcome I think is a lot more complicated than simply saying yes, boosting manufacturing jobs here in the United States is going to be a good thing.
Right. And there's also a timing issue. It takes 3+ years to build a new factory from bottom up, and hundreds of millions to billions of dollars to build that new factory. And we know that Trump's term is 4 years. So as a CEO of a major company, I have to weigh, do I onshore some of this manufacturing, build the factory, put all this time and money into it, and then I only have maybe a year or
Right.
less to operate that factory before maybe tariffs go away, right? So, there's a lot going on here that really complicates the issue, and I think kind of dampens the original goal.
Yep. So the second goal really is raising revenue via, the taxation of imported goods. We all know that one of Trump's major plans of this administration is to try and balance the budget by the end of his term. So raising revenue would work towards that goal. There's a big problem, though, is that the amount of money that could be generated by increasing tax revenues is really a drop in the bucket compared to um, things like corporate taxes, income taxes, reducing the interest on our debt, things of that nature, right? So even a doubling or tripling of our tariff revenue it pales in comparison to other ways that we could, be saving money or spending less.
Yeah, just to put some perspective to that, uh, we would need something like around 50%, a 50% tariff rate on all imported goods and services to close that gap. That'd be huge. That would need to be a very, very large dollar amount that we're tariffing in order to balance the budget.
Right. The third goal, I think, is probably another reasonable one, right? Using the tariffs as leverage to negotiate fairer trade deals. Again, I think most countries have shown a willingness to want to come to the table, want to agree. I think trade deals with places like Vietnam, where a lot of our apparel and clothing is made, somewhere like China or even the EU and Japan with the auto markets, right, would be very impactful. The problem, as we've seen, is that if people don't want to play ball, like China has said, they're willing to go to war. They don't want to, but they're willing to fight this. It can start trade wars, and that's just inherently bad for our economy, right? I've heard countless stories of small business owners having to put orders on hold because overnight the cost of those, landing those shipping containers went from 50,000 to 150,000, right? So there's clear reasons why this might not be favorable in the end.
Right. And I personally speculate that this is the main reason for the tariffs, right? Even what we talked about before, raising revenue by taxing imported goods. It's hard to say that you're using tariffs to raise revenue when you increase tariffs, but then you also say these can be negotiated down, right? Because if these can go away, then you're not really meeting that objective. Now, when you think about this, using tariffs to negotiate, and you brought up trade wars, Adam, uh, it reminds me of an age-old saying: when play with fire, you can get burned, right? And you can get burned, right? Trump right now, the Trump administration is playing with fire, and that could burn us. Now, on the flip side of that, fire is very productive. Fire has brought some very productive things to us as a society in the long run. So playing with fire can also turn into some pretty great things. So while we're saying that, there are risks to this, there are, risks to the downside. There's also risks to the upside, right? This could actually turn out to be something great for our economy if it works out in our favor. The big question, or the big word there, is if.
Yeah. We had a question come in. I talked about the interest on our debt. We had a question. Do we believe there's any validity in the rumor that the administration is using tariffs to reduce long-term bond yields? Um, I don't necessarily want to speculate. Uh, Is it possible? Yes. But I do tend to believe that whether you like the guy or hate the guy, I think there's probably something he's planning, or there's some greater plan of why he's doing this. Like you said, maybe it's a leveraging tactic to negotiate better trade deals, fairer trade deals for the country. Something. Could it be that he wants to cause a recession and get the Fed to cut rates, and that will lower bond yields, and he can refinance the US debt, or maybe his own personal mortgages? I don't know. I tend to believe that there's some other aspect here that we're not privy to at the moment.
Right. And I think the funny part is, so he's calling on the Fed to lower rates. And I think in the environment that we're in, if we were to separate this whole tariff conversation, say it didn't exist, you could make a strong argument for the Fed should be lowering interest rates right now. But then when you add the tariffs in, the Fed knows that tariffs alone, they may cause a short-term bump in inflation, but at the end of the day, we all still have the same amount of money in our pockets. So if you're getting paid $10 a month, right, $8 goes to spending on, different things, $2 for discretionary, and then all of a sudden you need $9 to spend on your life. You're only going to spend that $1 of discretionary because you only have $10 that comes in. If more money is flooded into the economy as something like this is happening, that's when you increase the risk of inflation. So if the Fed were to lower rates too early, there is a risk that that would flood more money into the economy, right? Which could spur inflation, which is what the Fed has their eye on. So while he's calling very strongly for the Fed to lower rates and even threatening Powell's job, uh, you know, I'm looking at it from the Fed's perspective, and I'm saying they're probably looking at this saying, well, just stop doing what you're doing, and then we'll lower the rates for you. Just yeah, just ease off the tariff conversation. So it's just an
Right.
interesting tidbit there.
Maybe that's what happened before this morning.
Maybe.
um, I mean, all this can flip on a dime too, right? We're spending a majority, the lion's share of this presentation talking about tariffs, and who knows what's in store or how quickly it might get reversed.
Right.
It already has been paused for 90 days in some sorts instances, right? So the last goal here that we wanted to talk about is just protecting strategic industries and our own national security. The fentanyl inflow into this country was a big reason for pressuring Mexico and Canada to protect the borders and from their end. Um, I also want to highlight the amount of cybercrime and intellectual property theft that is rampant and is, bragged about in foreign countries by bad actors, right? So this again is a reasonable goal. I just think we have to be careful about retaliation from other countries or even supply chain disruptions, right? The last thing we want is for, U.S. plants abroad to be shut down and goods can't get into our country and have a shipping backlog like we did in the COVID times. The last thing I'll sort of say on this subject is just this really feels like our own country's Brexit moment. And for those that don't recall, 2016, the political Conservative Party came into power in the UK and basically voted to leave the EU. And it was politically driven, self-inflicted harm that put up walls and barriers, contrasting global free trade. And at the end of the day, it wasn't beneficial for anyone. It wasn't beneficial for the EU. It wasn't beneficial for the UK. And I worry that that's the situation we're sort of putting ourselves in here, where it's self-inflicted. And again, this is something as a country we've strived for, is to have freer trade. It increases our own quality of life. So the only thing I'll say is that hopefully this is resolved sooner rather than later, or there's some grandiose vision that we're not privy to that will end up making us a better place for it.
Right. Because what we want to avoid, and you mentioned this on another episode we did, Adam, is this feeling of paralysis of the
Yeah,
major CEOs out there feeling paralyzed and not making a decision. We need the flow of capital in order to see, our stock market rise and grow. If all of a
100%.
sudden major companies are holding back spending because they're not sure what environment we're heading in, or they're not sure what's going to be tariffed where and how much, et cetera, they're going to stop spending as much money, right? They're going to be in more of a defensive posture, and that could hurt the economy. It could hurt the stock market because that flow of money gets hampered.
Yeah. And lastly, we put on the right side of the screen here. There are notable companies, domestic and foreign, who have committed large sums of money to capital investments here in the U.S. since the tariffs started to be talked about during this administration. So, there is real money that is going to be flowing here, real benefit to the economy. Whether that's enough to offset the damage that maybe has already been done or will be done if these tariffs stay on for too long, that's to be determined.
Right. And just a footnote that it's very hard to tell what was truly already going to happen in terms of this 3+ trillion number, what was already budgeted, right, to happen, and maybe these companies are
Right.
just being louder about it, and what is actual, decisions to, move capital into the U.S. because of what's going on. There probably are components of both, but I thought it was only right to footnote that.
Sure. That's fair. So all these tariffs, right? What's causing, is it the tariffs that are actually causing the market to sell off, or is it something else? We took a look at the economic policy uncertainty index. This was something we read about and researched a little bit more in detail. This is something that's tracked by the Federal Reserve of St. Louis, and we looked at it. It comprises three main factors that impact the index. The first is 10 large US newspapers and their search activity and citing of the word uncertainty. That's the first thing here. The second is tax code provisions that are set to expire and the disagreement over the resolution by economic forecasters of those tax code provisions. A little complicated there, but keyword is just the disagreement of the amount of parts of the code that's coming due and up for renewal. And then the last thing is the dispersion of the Philadelphia Fed survey of economic professionals. So when there's more dispersion in their forecasts, that signals that there is more uncertainty there, right? And you can see this has spiked over time, and it usually spikes in times of panic, oftentimes in recession as well, right? So in 1998, you can see there that was the Asian contagion, the banking crisis and currency crisis over there, and then you had it during the tech bubble, and it spiked again right around 9/11 attacks, and during that recession, also during the financial crisis in 2008, 2009, we saw the uncertainty index spike as well. COVID, that was very scary and no one really knew what was going on. And we're seeing it spike again here today, being more, I would say, more politically driven than necessarily anything systemically financially related at this point, which hopefully it doesn't turn into that.
Right.
So it's noteworthy, it did stay elevated for a long time after the 0809 financial crisis, but it's rare to see the this index spiking for reasons not, financially systemic.
Right. What stands out to me is based on this index, we are more uncertain about the economy, or sorry, just as uncertain about the economy as we were during COVID, right? And COVID could have been the zombie apocalypse. We had people dying, we didn't know how to contain it. That was scary. We had businesses shutting down, we didn't know when they were going to reopen. Uh, that uncertainty is being matched by the uncertainty we're seeing today, which I think puts things into perspective. Either, looking at uncertainty just bottom line, or maybe looking through, looking at a step deeper and saying, are people overreacting? Is this justified, et cetera? We do know how quickly the COVID stock market turned around, right? We had the huge dip, biggest 1 month loss, I think, in record for the US stock market. And we ended 2020 on a positive note, with very nice returns. That's not to say it's what's going to happen today, but just to put some things in perspective.
No, I think it stresses that as soon as there is clarity, the market could rebound pretty quickly. We had a question come in, earlier. So if we could look into our crystal ball and say how long would it take for the market to recover, I think a lot of that depends on this, right? How much longer is there uncertainty, and can major Fortune 500 company CEOs effectively run their business into the future and plan for what's in the months, years, and decades ahead. When policy is uncertain, it's a lot harder to do that. If you freeze investments across on a global scale, that can have negative ramifications for the economy. And I think what's also important here, looking at the right side of the screen, is not just the citations in the news that are saying things are uncertain, but it's the Fed members themselves. There's 19 of them in the FOMC, the Federal Open Markets Committee, and every quarter they give their assessments of the economy, and they do measure this. They say whether their uncertainty about unemployment or GDP growth or inflation. They suggest and evaluate whether each member thinks their uncertainty is lower than it was before, about the same, or higher than it was before. Okay. And so what we're looking at here is the 19 members tallied up. The dashed blue lines is where they were in December. So you can see about 12 of them thought that, or 11 of them thought that their uncertainty in December about the unemployment rate was, about the same as where it was in September. Now, fast forward to March, and you can see that there's only three members who have a similar level of uncertainty about where the unemployment rate is headed. Most of those have shifted over to having a higher level of uncertainty about where the unemployment rate is being able to be projected. Okay. And the same trend about GDP growth, a lot more higher levels of uncertainty around some of these major economic factors. At some point, you have to imagine this is going to play into what they're actually doing when they manage and pull the levers for lowering rates, doing quantitative easing, slowing quantitative tightening, whatever it might be.
So we talked about economic uncertainty. Let's get into how consumers are feeling about their finances and the economy.
Yeah, I don't think there's any doubt that when things are uncertain, people feel uneasy, right? And there's a measurement for that, thankfully. The Consumer Sentiment Index is run by the University of Michigan. And one neat thing that's been more apparent in recent years that they do is they actually break this out by political party. So we wanted to highlight this. A lot of the stress you may be feeling or not feeling and wondering why everyone's going crazy about something so great or why you think this policy even has legs in the first place. Why would they ever do something so silly? Whatever your political views are, probably suggests how you're feeling as well, right? So I think it's always important to look at this from a level-headed perspective and say, is this good or bad for the economy? But try and take your political views out of this. And this chart just simply shows why that is, right? It starts in 2016 when Obama was still in office, and you can see that the blue line here is the Democrats. A higher number represents they feel better about their current economic standing relative to everyone else. And you can see the blue bars are higher there, north of 100. And Republicans, when Obama was in office, was slightly lower, down at 80%. But people generally felt good. I think this is what, 7, 8 years removed from 2007 and the great financial crisis. Um, then you can see this totally flip, right? As soon as Trump takes office, nothing major happened in the economy between 2016 and 2017, but there was a change in the political party. And all of a sudden, Republicans start feeling better because some of the policies might favor them or be among some of their core beliefs relative to Democrats, which dropped. This again flips in 2020, you can see everyone's sentiment and feeling about where they stood in the economy dropped. But again, once Biden took office, won the election, you could see these trends changing here. And now we're back to Trump 2.0 taking the office again, and Republicans are feeling better, albeit lower than we were in 2017, 18, 19, when things were um, you know, more stable, I'll say, in the economy. But I think it's also worth noting that the independents very closely track the actual overall rate, right? So maybe if you are an independent out there listening, you're a true measure of consumer sentiment across the nation. But I think this is worth noting and just trying to, when we think about our money, when we think about our investments, let's try to put views and opinions aside and look at the facts, look at the data, and make sure we're making rational moves with our portfolios.
Right. And I would say not just to put your political views aside, but acknowledge them, right?
Yeah.
Acknowledge that this is going to have an impact on your thinking, right? Because by acknowledging it, we can approach it. If refuse to acknowledge that your political beliefs impact how you feel about your finances in the stock market, then you're not going to be able to approach it at all. You're not going to be able to move past it. So yeah, I think it's important just to, when you're thinking about these things, if you're a Democrat, reframe things in your mind. I think this about my finance now. I think this about the stock market. I understand that there's a political component in that. On the same side of or the other side of the token, if you're a Republican, the same, but in the other direction.
Yeah. Not to dismiss it. I like that. Acknowledge it instead. Investing is a callous business. The stock market or, companies' earnings don't really care about how you feel. Um, but at the end of the day, all of these companies have a duty to shareholders to increase their profit margins, grow revenues, et cetera. So, whether policy is favorable or not, doesn't matter whether it's Democratic or Republican, I would say.
So, right. So we talked about economic uncertainty. We talked about pessimism over the markets. Is now a bad time to get new money to work? Is it better to say, you know what, let me hold back, let me wait till there's more certainty, let me wait till there's less pessimism? That's a question that, we've talked about in the past that I think is helpful to get into right now again.
Yeah, we've looked, over the last couple of years, we looked at, well, what if you invested at all-time highs, which we'll get back into in a second. And now it's nice to be able to say, well, we had a correction, we had a big market sell-off. Should we be investing now, or is there more pain ahead? Right. And this is a great chart from JP Morgan. They kind of look at a longer dated time frame of the same consumer sentiment index we were talking about, and they just wanted to identify where are relative time periods when people felt the best or felt the worst about their standing in the economy as a whole, right?
Right? And
So those
as
are
the line moves up higher, that's when people are feeling better. As it moves down lower, it's when people are feeling worse.
right. So a relative sentiment peak that they call it is, where sentiment starts to turn lower in aggregate, and it's a relative top for that. We looked at forward 12-month returns, and then they looked at where did sentiment actually bottom and where did people feel the worst, and what were the forward-looking annual returns in those time periods. And ultimately, what we can see is that of the 9 sentiment troughs, where did people feel the worst and only start feeling better after that? The forward-looking 12-month returns were on average about 24% over a year, right? That's almost, triple the long-term historical averages for markets. So I think it's fair to say that when you feel the worst is probably the best time to invest. Now, will it get worse from here? Who knows, right? In 08, 09, it certainly got worse before it got better. But when you look out over a year time frame, that's a lot of time for things to slow down and start to see the light at the end of the tunnel, which the market is always looking ahead, right? The market is not looking at what's happening in the economy today. The market is looking at what's happening in 6, 9, 12, or even 18 months out into the future, right? So when things look and feel the worst, they're probably going to be better a year in advance, and the market can do very well under those circumstances.
Right? And just to take the veil off of this, just to understand why this may happen, if you think about it, when you go to purchase an investment, you're thinking, well, what is the future value of this? Am I getting into a good investment? When there are episodes of panic and fear that spread through the markets, people aren't saying, what am I selling for and what's the future value? They're just saying sell. I just
Right.
want out, right? They're less concerned about the future value of their investment and they're willing to sell. So for those investors who have the discipline to either stay put with their allocation or take the opportunity to buy investments, right? There's always two sides to every trade. There's a buyer and there's a seller. When someone's selling, someone needs to buy it, and vice versa. And then there's a winner, right? One of those parties win in the long term. So when in periods of panic, when people are less concerned about what price they're selling at relative to future value, that is generally historically an opportune time to pick up those investments. So, and then on the flip side, when people are feeling the best about the economy, they're more likely to think too highly of the future value of the investment. It's a better time to sell. So I think, you know, you said it, Adam, when you're feeling the worst, that probably means there's a better chance of outperformance by doing the opposite of what you think, right? I would
Right.
also throw on there, by the time that you start feeling better, you likely missed out on the stock market's best returns. Okay. So just to keep that in mind when you're making some of these decisions.
Right. The market doesn't have the time to wave the white flag and say, "Okay, everyone, come on back in. The water's warm,"
Right.
right?
Right. Right.
Yeah.
Exactly.
So, it begs the question, is there a best time to enter the market? Is it then? Is it before then? Right? I, what we don't know is how bad things are going to get in the future, but we do know that they have gotten bad. We had the market sold off at one point, peak to trough was around a 20% decline, but we were still in that correction territory, down at least 10% from the highs. And so we looked at, well, what's the worst case scenario? Let's start there. What if we invested at the peak of every bull market, the absolute worst time through history? you can see that annualized on average, you're not doing any worse than 5.3% having invested at the worst possible time over, some of these time periods span 30, 40, 50 years, 70 years even, right? Approaching 70 years, I should say. So, even looking at the peak in 2000, right before the lost decade of stocks, right? You had two massive bear markets in 2000 to 2002, and then again from 2007 through the early periods of 2009, two huge bear markets, two of the biggest since the Great Depression. You still averaged as an investor 5.3%, right? Even 2007, right before the great financial crisis, you averaged 7.8% on average since that point. Still a fantastic return. And even at some of the worst periods on here, 2022 and 2000, you're still doing better than what you could buy, a 30-year treasury for today.
So we're saying that you invested money at the worst possible time that year, right before a major market drawdown. So you put your money to work and the market just fell, just bottomed out, right? On average, if we extrapolate out today, your return with the worst timing possible is 7.5% on average,
Yeah.
right? So if you consider where bond yields are today, right, would you rather a 7.5% return or what bonds are currently paying? And you're focused on return, right? I think that 7.5% looks more attractive. It certainly looks a lot more attractive than cash, right? So we need to keep that in mind. We also need to keep in mind that we're not at the peak, right? We've already fell 10 to 15%. So that increases that return a slight bit more if you're gonna, just try to, extrapolate this forward.
Absolutely, right. So on the right side of this chart, to that point, what about, had we invested only after a 10% market correction from the recent highs, right? So we have here since 2008, all of the dates where we entered and closed in a position where we were down at least 10% from the recent highs. And then we highlight what was the return a week later, a month later, 3 months later, 6 months later, and 1 year after that time period. And what you can see is that there's still definitely some bad times in there. There's a bunch of red I see on the screen, but there's a lot of green, and the green is significant returns in some cases. Okay, so if we look at only investing after a 10% pullback, you can see that 86.7% of the time, you have positive returns 1 year later, right? That's down at the bottom right of your screen. 86.7% there. Thank you. And on average, you actually had a return of 15.3% 1 year after investing after a 10% correction. So I think it's also important to note you shouldn't wait for those corrections. We've talked about that in past episodes, which you can go back and watch. Because it could be years before you get those 10% corrections. And, those 10% pullbacks might be above where our starting point is today. So you shouldn't be waiting. But at the same time, if you have been waiting, now is a relatively good time, even in some of these bear market years. Yes, the 1 year forward returns are not necessarily guaranteed to be positive, but there's a high likelihood that, you know, this might not be a bear market. It might not be prolonged. It could be just fine. It could be an overreaction. Why would you risk taking that gamble if that money, is meant to be geared towards longer term growth anyways?
Right. If this is longer term money, if this is 10-year money, we should be less concerned about the next 3 months, the next year. Right. And this really does translate to real dollar amounts. So I meant to bring this up before, but if we look back on the left here and we're going to pick on 2007, if you invested $1 million right before the market falls about 50% over the course of a year and a half, 2 years, right? You put $1 million to work at the worst possible time, the market bottoms out. Today, that dollar value, that portfolio would be worth over $3.5 million, be worth close to $4 million. That means on average, you're making $150,000 a year on that investment from that point until now. So that's a real number. That's real dollar value. So when we're thinking about, putting money to work, we really need to, think about what's fear oriented and what's actually long-term return oriented. and try to push ourselves to be more long-term return oriented. Now,
And
with that, yeah,
think of all the different reasons from 2007 to today, all of the different reasons that have come up about you thinking maybe I should sell my stocks, right? There's every month there's some news story that seems really scary. It could be cause for concern. The longer we stretch this out, the more severe those instances become. It really does just become a factor of how much time are you actually spending, reaping the benefits of compound interest.
right. And now is an important time to have a plan in place. We're talking a lot about staying disciplined to a plan. For a lot of investors, that means not pulling out when things get rough, right? To stick to the whatever plan you have set, make sure that you start on the right asset allocation foot. You don't have too much in the stock market to begin with, right? There are other markets we could take advantage of returns from bonds, alternatives, money market funds, etc. Now we do have clients though who have enough money to meet their plan, right? And who may just be more defensive by nature. And for those clients, during pullbacks, we may be more risk oriented, but those clients also understand that they're giving up potential future return by becoming more defensive. So I think having that honest conversation with yourself of if the market does, move up, if I do get, if things turn around quickly, uh, am I willing to give up that extra return? Am I willing to have a 5% return instead of a 10% return if the market goes up 10, right? If you're okay with that and it's going to help you sleep at night, then maybe lower that equity exposure. If you're not okay with giving that upside, then, you shouldn't, right?
Right.
Because it is definitely plausible. We had a couple days where the market fell by more than 5% in one day just recently. That can, as we unwind from this, if we unwind from this, that could happen in the opposite direction.
Yep. We've already seen it happen in the opposite
Yeah.
direction a couple days. But yeah, just pick up the phone and call us, talk to someone, right? There's so much news out there today. And, you mentioned CNBC at the top of the show. Look, they're not in the business necessarily of educating people. They are a for-profit company. They want to sell advertisements, right? So if they can, I don't know that they'll ever admit this, but if they can scare us into watching for longer and seeing, a couple more episodes or commercial breaks, that's good for them, right? They want the eyeballs. With Twitter and Facebook and all the news sources that we have today, I wonder if that creates more uncertainty in and of itself, because you can, I always say if you want to confirm a bias, just go look online, right? Because someone's going to be out there posting exactly what you want to hear. We pride ourselves on telling the truth from a financial perspective, from, as ruthless as sometimes that might be. But seeking that counsel can be a world of help. And, there was a question that came in: how can we make our 401k recession proof? Talk to someone, talk to an advisor. Let's have that conversation and see what the trade-offs are. To Austin's point, you can't have capital preservation and growth of your assets. Those two cannot work in concert with one another. You have to take on risk to get growth, and understanding that and having a plan and an approach to obtain sensible growth within your own bands of not pulling your hair out or grabbing a stress ball, whatever that might be, is ultra important when it comes to investments.
Right. So speaking of eyeballs, shameless plug. I do encourage everyone to tune into our podcasts, Amplified Wealth. You could look those up on any major podcast app, like it, follow it, so you get notifications when it pops up. A lot of great content there. So this wraps up the slides we wanted to show you today. So I appreciate everyone tuning in.
Yeah, well, I'll hang on for another few moments. There is a Q&A box if anyone has follow-up questions. But thank you again, as always, for tuning in, and we'll see you next quarter. And we have a copy of the PowerPoint came in. That's a
So
great question.
yep,
If you
I
want to
would say
reach
reach
out
out to, yeah.
to your contact or advisor, or email me as well, I'll drop my email in here, and I would be happy to talk to you and walk you through it. What are the best industries to invest in now, Austin? What do you think?
There's a lot of ways you can approach this. I think starting out with a diversified opportunity set makes sense, and then lean into whichever industries you believe are changing, going to be changing your way of life going forward. Or not even focusing on industries, focusing on individual companies and which companies are providing the highest quality, right, and are trading at better relative valuations. There's a lot of ways you can go with this. I could tell you a lot of the ways that you will hear about on the news. Oh, Trump is president, which means these industries should do well. That rarely plays out the way you think it would.
Right.
It actually plays out the opposite, which is something we've talked about in webinars and podcasts in the past. So I would be definitely wary of that. I think the smartest thing you can do as an investor is have a broad opportunity set, stay diversified, and then lean into areas of interest or areas that have proven empirically to offer higher risk adjusted returns in the long run.
Yeah, I think you need to just consider risks involved, right? So if you invest in one industry, it means you're not investing in 10 other industries in the S&P
Right.
500, right? So I think we should not be eliminating any industries, but we can, overexpose or underexpose ourselves slightly to certain industries that we feel have, you know, I like to look at longer lasting trends, 3 to 5 year trends that might play out. Um, versus what's going to do well in the next month or the next quarter. I think there's too much uncertain that can happen in a shorter time frame like that. um, and then I think, to Austin, your point, just picking the companies within each sector that have the highest likelihood of increasing their profit margins or growing their revenues above competition is a great way to start.
Let's not forget that the stock market is assigning a probability to everything, right? When you bet on a sports game, I just heard this analogy. When you bet on a sports game, you'll see plus 700, minus 700, where you get paid more for picking the underdog. That is how the stock market works. There's risks assigned to everything. If you pick the underdog and the underdog ends up beating out those risks and doing very well, you're probably going to be rewarded handsomely and more handsomely than choosing that other investment, right? That may have less risks built in. So being smart about even though you may be confident about a investment or a way of thinking about the investment landscape, uh, being being aware that that could work against you. You could be picking the investment that has lower risks and maybe lower upside. And if it doesn't play out that way, right, you want to be able to take all that into account. So that's why I say staying broadly diversified first, and then leaning based on your thoughts makes sense.
Yeah, that really there's a lot of ways to dice up that answer, but yes, it depends. It's a short way to maybe wrap it with a bow. And
Well, I needed to get us to one.
yeah, there you go. Well, thank you very much, everyone, again. And until next quarter, please be well.
Great. Thanks, everyone.